10:02. Take roll. I'm William Pearlstein.
I'm Jim Little.
We've received the audit report, financial statements of the city. Bert, I think you should begin, maybe introduce the outside auditors so that they're identified. And
This is Jeff Kowalczyk and Joe, I would call him Manfrey. I've been watching Tulsa King.
Can you pull the microphones closer, please?
Sure. And they are from the firm of Barbicane Thornton and have served as our outside auditors for a number of years. And Jeff and Joe will go ahead and present the report, I guess, now.
Yeah, absolutely. Thanks so much for having us out. We're delighted to be here presenting the results of our audit for the year ended March 31st, 2024. The document you have in front of you is the result of our work, which was a combination of transactional testing and control and process testing that we performed over the summer and into the early fall on the processes, the financial processes and results of the city, all for the purpose of determining its material accuracy. And I'm pleased to let you know that we've issued an unmodified, also known as a clean opinion, on the financial statements for the year ended March 31st, 2024. Additionally, because you expended more than $750,000 that originated at the federal government level, you were subject to the federal single audit requirements for the year. So you also had a single audit. Joe is going to go over that in a little bit, but I will spoil it and let you know that there were no material concerns there. So to jump into the financial statements and the results for the
Our threshold on that last audit.
it is $750,000. There is currently a movement to move it up to $1 million, but that is not in effect yet. But I would imagine that it'll be soon. The first 4 pages of the financial statement document, and when I say the pages, I'm going to use the page numbers at the bottom of the pages. I apologize if you're looking at it electronically. The page numbers might be a little different just because of the PDF page versus financial statement document page. But pages 1 through 4 are our independent auditor's report. As I said, unmodified opinion. It discusses management's responsibilities for maintaining the books and records throughout the year, pointing out that it's not just a point-in-time audit. It's not something you can really, for an organization this size, you can't just sort of make it up after the fact. You really need to be operating, following controls throughout the whole year to arrive at an unmodified opinion where the processes are in place such that the financial statement numbers can be relied upon. It also talks about our responsibility for designing tests and procedures to obtain reasonable assurance about the accuracy of these financial statements. It also talks a little bit about how we also, because you undergo the federal audit and because you're a governmental entity, in addition to generally accepted auditing standards, we also follow generally accepted government auditing standards, also known as the Yellow Book, which provides a little bit of more emphasis on the controls and processes than a sort of like a nonprofit or a small company financial statement audit. After page 4 is management's discussion and analysis, which provides a narrative overview of the city's results for the year. And it answers not only the what, but it also talks a little bit about why. Why is revenue up or down? Why are expenditures up or down? You will see that it is marked as unaudited, but I do want to clarify a little what that means. As part of our audit procedures, we are required to verify that the financial data in the management's discussion and analysis ties with and agrees to the financial statements, and that it has all of the things that government auditing standards require is included in a management's discussion and analysis. The reason it's marked as unaudited is because as auditors, we're able to issue opinions on the what, but not the why. And especially where it talks about future factors that could impact the city, that is sort of outside the scope of the audit. So it's actually the stuff that I think makes the management's discussion and analysis the most useful section. If somebody was just going to read one section of the the report, that makes it unaudited. It doesn't mean it's wrong. It just means we can't issue an opinion because it's outside our professional scope.
This may be directed at Bert, but on page 8, the table 1, just notice on the business type activities, the other liabilities went up considerably from 2.3 to 4.8. Can somebody tell me what that is, if you know offhand?
Yeah, so I can actually answer that for you, Bert. So there's two things that go into that. Probably the biggest one is that the short-term portion of notes and bonds payable, because they're due within a year, are included in that other liabilities instead of long-term liabilities. And because of the timing of the repayments and additional draws on the debts, the notes and bonds went up about $1 million. The remainder is due to the changes, the fluctuations in the balances due between funds. So if you were to jump to page 24, you'll see that both of those accounts went up about $1 million, or about $900,000 each. There was also an increase in accounts payable, which was due to the timing of payments on the ongoing projects.
Yeah, thank you.
Yep. Great question. So
So the adjusting entries that you had, those were just the two that you sent us? Those were the only adjusting entries that you had?
was it? Yeah, we had very minimal.
Very minimal.
Yeah.
That was it?
That's correct.
Yeah.
Good job, Bert.
Yeah.
Thanks, Chair.
Bert takes a lot of care in the precision of the data before we receive it. I'll absolutely say that. So page 18 is where we start the financial statements proper. And pages 18 and 19 are a little different from what is reported on a monthly basis because they are on a full accrual basis. So this means, so during the year, the city budgets its governmental funds on a modified accrual basis. That means that you're looking at near-term financial uses and sources. So things like when you purchase a capital asset from the general fund, in the general fund, it is recorded as an expenditure. The statement of net position and the entity-wide financial statements instead look at it as a long-term asset and record depreciation. So the statement of net position looks at all of your funds the way the city would look if it were a business. And you'll see on that basis at March 31st, 2024, you had total assets and deferred outflows of resources of about $162 million, offset by liabilities and deferred inflows of resources of about $73 million. In both cases, the biggest bulk of the assets are your capital assets, with more of that in the business type activities because of the ongoing sewer projects. And on the liability side, the notes and bonds payable are the largest portion of your liabilities, making up, in their case, about 85% of your total liabilities.
Just one accounting question I have.
Yeah.
What is net investment in capital assets? How is that computed?
Yeah, that's a great question. So net investment in capital assets is the value, the capital assets on your books, net of depreciation, and then you subtract out any outstanding debt associated with the acquisition of those capital assets. If there was unspent bond money associated with the debts used to acquire capital assets, you would actually add that back in, but that's not the case in your city's case.
So simple math, and that's not right, but If I were to take total, okay, yeah, the math works. I look at it just real quick on the fixed assets less the debt, gives you approximately that number.
Yeah.
Those 4 line items, starting with construction and, or land, 2.8, those 4 items subtracted, and then you just take the debt from that.
Yeah, and I should note that because of the way it's accounted for, you would take the notes and bonds as well as the lease liabilities, just when you go home for fun and want to recalculate it. Looking at the next page, which is the statement of activities, you will see for the year, this is a good schedule as far as really understanding the burden of taxes and general operating costs on the city. Because along the left-hand side, you'll see a column for expenses, and this is governmental plus business type. You'll see total expenses of about $29.7 million. Next to that, we show program revenues, which is how much is received from charges for service, as well as operating grants that are tied to specific services. And you'll see when that's all said and done, that the net burden that taxes and general operating revenues are required to cover is about $5.3 million for the year. This was a year where, for a number of factors we'll see on subsequent pages, you were able to actually have general revenues closer to 10 million. And so you were able to see an increase in your net position.
Unless I'm missing something here, if you compare it to the year before, it's an increase of 2.8 million in expenses that were not covered by program revenues. Is that a fair read on that? The 7 million
Yes,
versus
so-
the 4.2?
Yeah, and we can look at it a little more in detail when we flip to those pages, but a big chunk of that is as the sewer project's put in place, recognizing depreciation on it is a multi-million dollar.
But I thought that was under the business activities. I'm looking under governmental activities.
Oh, I'm sorry. Yes, so that, and we can look at that in more detail. Some of that is expenses that had budgeted increases. Some of it is timing of various grants. But yeah, we can dig into that in more detail. And Bert, I don't know if you have a specific thing that jumps out, not to put you on the spot.
Well, I mean, I had depreciation in the government funds of 3 million. Does that
Yeah.
help you? 3.1, almost 3.2 million. So,
Is it depreciation, Bert?
yeah, the depreciation expense is, which you won't see as a line item on the statement of activities, but it was almost 3.2 million.
And what was it the year before?
I can tell you in a minute.
Okay, because what I'm focusing on is the 7 million negative on total government activities net of direct charges versus 4.2 the year before. So it's a $2.8 million increase in the cost of governmental activities that were not covered by direct program revenues, unless I'm
Yeah, no,
misreading this.
that's
I can verify that, but I think you're on the right track. I think it's
Yeah.
about right.
Okay.
Yeah, actually, if we jump to page 22, this is the fund level, looking at the general fund, and you'll see the expenditures did increase, and this excludes depreciation expense, but does include capital outlays, so capital asset acquisition as expenditures, although that number didn't really change. You'll see the fund level increase in expenditures was about $2.3 million. I will point out, and you don't have to flip there, but on page 52 is the budgeted expenditures. And budgeted expenditures for the year were actually about $22 million. So this does represent, even though it's an increase, it does represent an increase that the government had committed to through the budget process, and actually was able to see some savings against.
Can we change gears real quick?
Yeah,
Page 17,
yeah.
Economic factors, I think it's the last two sentences
Sure.
about the city property taxes. It's going to reach a ceiling of 3 million. Am I reading that right?
As the ceiling is 3 million, so we're close to the limit.
So you're basically 360 some odd $1,000 shy of that.
About right, yeah. That's
So
right.
to raise that 3 million, what needs to be done?
Well, I think, first of all, I think I believe the city has to have a referendum, but then I think the legislature also has to approve it. I'm pretty sure, I'm not, I'll verify that for sure, but I'm pretty sure that's the way it works. That I don't think we can raise the limit, the 3 million. That's codified in the city, in the city's code. So to raise it, whether you have to have a referendum or not, I'm not absolutely sure, but I think so. But I'm real sure that you have to go to the legislature to get permission to go ahead and increase it.
So basically, property taxes are almost maxed out. Is it?
Exactly.
Yep.
I noticed the same thing, and that certainly is a source of concern, if nothing else, inflation, unadjusted inflation number. So I think that from a viewpoint of the Audit Committee, it is a concern that we are capped on one of our major sources of revenue at a time where, as the city budget and otherwise talks about, there are enormous expenditures coming in.
Right.
So with the city manager here, I think it's worth at least flagging from our viewpoint a source of concern. The political issues are not our job, but the budget issues of capping a principal source of revenue that much is certainly seems to us to be a source of concern.
If I expand on that just a little bit, you have basically 5 sources of general fund revenue that make up about 75% of the total general fund revenue. The other 25%, a big portion of that is building licensing fees. But the 5 sources are really your property tax, your parking meter revenue, your rental tax, which is about the rental tax on residential properties. It's about $3 million you raise a year. The hotel tax, raising a little over $1.5 million. And then the transfer tax, it's over $2 million, but you're capped on those items as well. In that, I mean, transfer tax is going to be what it is. We have no control over that. And the same with the hotel tax. And the rental tax has increased. It was, we raised it to 7% in our most recent budget, but the state of Delaware is going to tack on another 4.5% effective January. So we're going to have an 11.5% for people, basically guests that check in. They're going to have to pay that 11.5% rental tax. So we're sort of capped there too. I don't know that we can go up more. So those 3 sources are capped. The only thing you have left is parking, and they raised that by 33% this past year.
I recall, and I remember whether it was in the auditor's report or in the city budget, but a comment that of those 5 items, 3 of them are substantially weather and economic climate related, in the sense of the parking, the hotel tax, and the so given the fact that whatever you feel the cause of climate change is, we can look to see what's happening in communities in Florida and North Carolina and others. And certainly one of the things we've raised in this committee previously is, the need for a rainy day fund, which I know we do have, no pun intended, after North Carolina. But a cap of 3 million, given frankly the number of us who have moved here now permanently, does seem to be handcuffing in some ways the ability to do long-term planning. So I think, at least from my viewpoint, asking the city to address what the prospects would be for changing if it needs to be voted on. That's always hard to do, as we've seen with the school district trying to get increases as well. But it is as you said, Bert, a major source of the 5 points of revenue, and one that, as Jim says, is just about capped out.
That's right.
Right. So the next section to go over will be the fund level statements. They begin on page 20 with our governmental fund statements. This looks at your general fund as well as your non-major governmental funds. And you'll see at March 31st, 2024, total fund balances there were about $24 million, the majority of which was available for use as determined by the city. Total assets are about $29 million compared to liabilities of just under $5 million. Again, the largest liability is balances that are due between funds. And then on the asset side, cash and investments, as well as balances owed to the city, make up the bulk of your total assets.
You've identified the interfund balances and the fact that they run for a fairly long time period during the fiscal year as an item I think you've raised the last couple of audits. How concerned should we be? I do understand the good housekeeping, but
right, exactly. And so there's different ways we look at it. There's when it becomes a concern is when one of your funds is regularly running a deficit, and the only reason it has cash is because it owes money to another fund that it doesn't really have a way to ever repay. So right now, we're just talking good housekeeping, because right now, each of your funds, whether or not they are positive in the year or a little negative, especially if it's because of non-cash depreciation, we see cash flow sufficient to cover the cash needs of each fund. So they are standing on their own presently. As the sewer fund starts to mature with the new project, it's always worth exploring. I know there'll be a lot of debt repayment, and that's where we kind of will look and say, okay, are we still good? Are we still covering? Is everything still fine? So right now, it's a housekeeping matter more than anything, but it's something we keep an eye on because we think it's important to make sure that we're not slipping in that direction.
thank you.
But isn't this basically intercompany and it doesn't at the end get eliminated?
It is basically intercompany, but each fund is reported independently, so it does show up as balances due. And as we saw, because government and business type are even in the MD&A reported separately, it does show up as assets and liabilities. And it's not, you're right. If we looked at the city as one set of books, it would all eliminate. But because of the way the city operates, it's important to keep an eye to ensure that each of the funds is managing itself independently, or that if transfers from one fund to another fund are a way of doing business, that they're being formally approved by the governing board, as opposed to hidden in effect.
I think the simple solution really is write a check, and I can move money there. Actually, the sewer fund, I think you'll see on the fund statements, it had about $185,000 surplus. I thought there would be more losses in the sewer fund and that it would sort of be self-correcting. But I can move a couple $1 million and be comfortable, and it would just be writing a check and moving the cash into the water fund.
Yeah. And then looking at page 22, which is the statements of revenues, expenditures, and the changes in fund balance. This is where we can see some of the expenditures we talked about, but you can also see the variations in revenues, or in many cases, the consistency of revenues. You'll see taxes was down a little bit, licenses and permits was down a little bit. Taxes, because of the significance of transfer tax and the large variance in them year to year, you won't necessarily, it's very common to see it go down and then up and then down and then up. And that is something that is, for all municipalities, very difficult to predict. Because if one or two large houses goes up for sale and sells in a year, you'll see an influx of transfer tax that can't necessarily be predicted. Consistently, or you'll also see charges for services up slightly. Intergovernmental revenues, which is generally grants and contributions from other governments, that was up pretty significantly due to some of the funding during the year. And then you'll see other things like fines and forfeitures were pretty consistent. Investment earnings was also up about $500,000. We saw, not historic, but higher than we've been seeing in the last 10 years, investment rates on CDs and other safe investments that governments are able to participate in after many years of near zero rates. We're seeing that start to trickle a little lower, so we're not sure how long that's going to last. But while it's there, it's great that the city was able to monetize the funds on hand a little to bring in those revenues. So overall for the year, you saw fund balances go up about $2.7 million, primarily driven by the general fund. The non-major governmental funds are your police grants and your municipal state aid for highways and streets. So they're pretty much money in, money out. So they stay pretty level year to year. Pages 24 through 26 are the proprietary funds, which are your water and sewer funds. We've talked about them some already, so I won't go into too much detail, except say that your total assets and deferred outflows were about $97 million at the end of the year. Your liabilities were about $55 million, and that left you with net position of about $42 million, which was pretty evenly split between the net investment in capital assets and an unrestricted net position. Although I will highlight the water fund, as a more mature fund, has more unrestricted net position, and the sewer fund, because of the recent projects, has a higher percentage of its net position restricted in capital assets. Although the intention is that will come down as the system matures and depreciates, and as the debt is repaid. Page 25 highlights the results for the year. As Bert noted, the sewer fund pretty much broke even. You saw a slight increase in net position. The water fund also saw an increase in net position for the year as it saves money for future replacement and repair needs. You'll see capital contributions in the sewer fund this year of about $1 million, which is significantly less than in the prior year. Those are the contributions that the county has made to the sewer project.
The $982,000 that you see, basically the agreement when we had the outfall agreement put together was that the county would pay 42% of the debt service costs. So basically, as we get the bills, we just go ahead and send the county a bill for their 42% share. So that's where that 942 is coming from.
Well,
982.
so pages 27 through 50 are the notes to the financial statements. So they provide a lot of the additional information that I was presenting to you, as well as talk about the city a little bit. We're fortunate in that there were no new accounting pronouncements to implement this year. finally, for once. Basically, it usually takes about 3 to 4 years for a pronouncement to go from the board thinking it's a good idea to us having to put it in place. And 3 to 4 years ago was the height of COVID. And so they were putting out temporary emergency guidance. So they kind of got their projects a little delayed. There'll be a new standard on compensated absence accounting, so accrued sick and vacation time for next year. It's not going to have a significant impact on the city, but we got a 1-year respite. I'm happy to answer any questions that anybody has about the notes, but because they're materially consistent with the prior year, I figure I would leave that to questions that you may have. And I think before we go into the single audit briefly, I think let me pause and ask if there are any questions.
I saw where you did the leasehold.
Yeah.
Where's that on the balance sheet? I was looking for that.
The is this for
The
the
lease,
the lease amortization? So that is, if you're on page 18, in the capital assets section, the fourth line is leased assets net of amortization. And it's about $640,000.
it was just an in and out. You got the same amount on the asset as well as the liabilities.
It is really close to an in and out. Because the liability is amortized based on an imputed interest rate and the asset is straight line amortized. So at March 31st, 2024, the asset was $640,000 and the liability was about $630,000. But over the life of the lease, it has net zero impact.
Can I, a technical question on page 33, note C. Sure. We referred to the FDIC insured accounts and that we have to have collateral above that. And
Yes.
Bert does regularly send us a note on that. There's also a reference to SIPC, which is the Securities Investor Protection Corp for brokerage accounts. That's a whole different system. I just want to make sure we're not leaving a lot of money at SIPC, because the SIPC fund does not operate quite the same way as the FDIC fund does.
Yeah, you're absolutely right. That's basically protecting us against malfeasance on the broker's part.
Right, but it doesn't protect us against somebody failing in the same way that the FDIC does. So my question, Bert, is do we, normally when I've worked with SIPC funds, people are not putting up collateral the way they are with the FDIC funds. Right. So I just wanted to flag it to make sure that we're not leaving a lot of money in SIPC accounts unless we do have collateral.
Well, my understanding is, I did, a little research, and, if a brokerage firm failed, say Edward Jones were to fail, those assets are really not on their books per se. There are assets, and that I guess in past history, if brokerage firms fail, unless the broker's been crooked and taken our assets, but we have treasury bills in an account held at Edward Jones. So I believe that, and that we're covered. We're pretty safe on that, unless they were to take that money and out of our account. We get a statement every month that we monitor and record the interest on.
Yeah.
So,
I think that the other important thing is to highlight that any investment held at that's an investment is a government security. It's extremely safe investments.
Bert's making the right point, though,
Yeah,
which
okay.
is that they're custodial accounts.
Yeah.
And as long as they aren't breaching the custodial account, we're not at risk for, take an example, Edward Jones's liability. The risk would be if they were to invade it, which is arguably what happened with FTX and some other funds, where they literally took custodial accounts and used it for corporate purposes. So I think you've identified correctly exactly what the only issue would be there. With a custodial account, you're in theory not exposed to the vagaries of changes in interest rates and things like that as you would be with a bank account where it's not a custodial account, it's actually an obligation owed by the bank to you, which is what a bank deposit actually is, and so that is a different issue.
Yeah, and I'm not sure, but I think in a lot of cases, and I know you have a banking background, so you would probably know, but I mean, a lot of times if you have an asset like that, it's held by a third party. You know, of course, these are just digital assets, these treasury bills. But if you had actual securities, I think it's common to go ahead and have a third party isn't that what Bear Stearns used to do, pretty much?
You know, it does vary. I was an officer at Bank of New York Mellon. That's what they do. It's,
Yeah, right.
you know, and so I don't know what the Edward Jones situation, you know, just, I'm not picking on them at all, but you mentioned them. I don't know whether they are self-custody or whether they're using a third-party custodian. You're absolutely right that if they're using Bank of New York Mellon or State Street as a custodian, then you have the protection that the actual securities are actually being held by a third party. I don't know with Edward Jones what their how they hold it, so I can't.
I'll ask, and I'm curious myself, but I felt secure in the whole thing, just knowing that if there was a failure, unless somebody had moved those assets, but the fact that we get a statement every month, of course, you know, somebody and fraud is, you know, can be done anyway. You could send somebody a phony statement if you wanted to, but I wouldn't expect that we'd have that at Edward Jones.
Understood. Thank you.
All right. So the last thing we had wanted to touch on is the single audit results, and for that, I will turn it over to Joe.
Yeah, thank you, Jeff. Yeah, so starting on page 62 through 66, these are the reports that Jeff had mentioned earlier, just basically covering, you know, that you have an unmodified opinion or clean opinion over the controls, over compliance. But really what I wanted to speak on was starting on page 67 through 69. So this is the schedule of expenditures of federal awards. And there were two major programs this year that we looked into. One being the COVID ARPA money that was received by the city. You spent about $831,000 last year. And you obviously, as I mentioned, you've received an unmodified opinion on the, you know, everything there, as well as you did spend a little bit more money, as Jeff had mentioned, around the projects of the, you know, the clean water state revolving funds. You had additional draws on that loan of about 1.4 million. This is a loan that originates at the federal level. So anytime there are draws in excess of 750,000, that's why, you know, we have a single audit. And if you look at the outstanding balance of the loan, it's about 42.3 million this year.
Any other questions?
No, I'm good.
I don't think we have any further questions. Anything else you want to tell us? Any reason to have an executive session? We should ask you that.
Yeah, no, and I'm comfortable saying in public session that we do not have anything to report in an executive session.
Great, thank you.
The only thing, and I'm not sure whether the Audit Committee feels it's even their job to opine on this, but we had talked about a fund balance policy. A fund balance policy.
Yes.
And I believe I sent you some documentation on the worksheets that were done, and we've been discussing this with the commissioners, and nothing's been resolved, but I mean, basically, the whole purpose of fund balance policy is to protect us against ourselves by, you know, making sure that we maintain an appropriate level of fund balance, which essentially would be a limit. It would impose some controls on spending at some point if we had violated our fund balance policy. I don't think it's anything that is codified, but it is something that we're working on. So I'm not asking you to, I mean, you're welcome to, if you've had experience with fund balance policies in the past, you're welcome to provide any guidance you can or want to. But I just wanted to let the Audit Committee know that we are working on a fund balance policy.
And if I could just interject here, thank you, Bert. Again, I introduced myself at the start of the meeting. My name's Evan Miller. I'm the Assistant City Manager. I did just want to provide sort of a brief presentation on the fund balance and net position policy, if you would allow me to do so, Chair. First, I want to thank Jeff and Joe for being here. Appreciate all your work on this year's audit. I also want to thank Bert for all of his hard work in the preparation of these statements and also related to his efforts on the FY25 budget. If I could just briefly, I want to first recognize that for the 4th consecutive year, the City of Rehoboth Beach has earned the Distinguished Budget Presentation Award from GFOA. And this is presented by, again, GFOA. It means that the city's FY25 budget meets the highest principles of governmental budgeting. So I want to congratulate Mr. Dukes and the entire Finance Department on that accomplishment. I want to thank you for allowing me to be here today just to present the current draft of the city's fund balance and net position policy. Really, the purpose of this presentation is just to bring you up to speed on the latest draft and to solicit any comments, concerns, or ideas that you might have. Certainly, if you have any thoughts that come to mind after this meeting, please don't hesitate to reach out to Bert or me. So the development of this policy really started about a year ago, February of 2024. Bert and I had talked about developing a policy, I think, for several years before we actually started to draft one. So I'm happy to say that we currently have a draft, and we've had several meetings with the Board of Commissioners to try to refine this policy, and we'll continue to have more meetings in the future. It started off really with researching various other fund balance policies, including best management practices from GFOA. And there were several things that we really wanted to accomplish with this policy. So we wanted to avoid being overly complicated with the policy. That's why you'll see it is pretty brief, only 8 pages in total. And we also wanted something that could be revised on an annual basis. So as we start to develop the upcoming fiscal year budget, this is a policy document that we can go back and reference as we develop that document. So early on in development, we talked a little bit about it today, and that is the big concern that much of our revenue is dependent on the economy. So we have, in the general fund especially, we have several revenue sources, which Bert touched on earlier, which mainly are derived from the tourist economy. So parking, transfer tax, hotel tax, rental tax are main contributors in the general fund. And the big concern that we had as we started to develop this policy and why we really developed this policy was we wanted to ensure that we could continue to operate if we had a natural disaster or a turn in the economy, which led to a significant reduction in visitors. In addition, we wanted to make sure that we could sustain operations during such a disaster or a turn in the economy, wanting to make sure that we could support 100% of our debt service obligations, and certainly we didn't want anything to get in the way of meeting our obligations to our creditors. Another consideration during the development of the policy was the importance of our capital improvement plan, our capital budget, our capital projects. These are ones that are first vetted by the department heads. It then makes its way through the city manager's office for further vetting, and then finally to the Board of Commissioners and members of the public. So this list is really far, the capital budget is really far from a wish list, more identifying priorities, and they include important improvements such as street paving, water and sewer line repairs, equipment replacements, and facility improvements. And then finally, and I'll briefly go through the policy itself, we wanted to include a line in the policy for funding for natural disasters. So when a natural disaster hits, certainly if an emergency, a state of emergency is declared, it's likely that funding will become available from FEMA and from the state. However, this funding does not come immediately. In the trainings that I've attended, one of the things that they kind of preach over and over and over again is document, document, document. So document when a natural disaster occurs, any costs that you're incurring related to remediation. So it's important to have monies available immediately to help with that remediation. So just briefly scrolling through the policy, the latest revised date was August. So it is, it's been quite a while since we've been back to this policy. We wanted to bring it before you all for consideration. The first page really just goes into, again, some of the general goals. So making sure that we can sustain the municipal services, being able to withstand the impact of the local economy, as I talked about, and any environmental related hardship, and maintain an excellent standard of credit worthiness. So again, maintaining that obligation to continue to pay our debt service. So it's broken out into two pieces, the fund balance and the net position. Just scrolling through, I'll show you that we do have in here included some charts. The charts are really just an example of how the policy would be applied. So in this particular case, just going through the general fund, again, we wanted to ensure that we could continue to fund operating expenses. When we started off looking at the general fund, the first draft of the policy, we actually had 60% of operating expenses. And the intent there was to ensure that we had enough monies to fund roughly 6 months of operating expenses. And those 6 months that we looked at were the seasonal 6 months, since obviously expenses are much higher during the summer season. In this latest draft, we have cut it back to 30%. That was based on some of the comments that we had received during previous presentations, only because, to expect 6 months of absolutely no revenue may be unlikely. So we did trim that back to 30%. That's roughly 3 months of operating expenses during the summer season. Moving down, 100% of the debt service cost was important to us, and we've also included 100% of the CIP financed with current year revenue. There was a little bit of discussion at the commissioner level about this particular line, 100% of CIP, because certainly we would have an opportunity like what happened back in 2019 and 2020 during COVID, where we could actually defer some of those capital items. But it's really hard to put a percentage of the capital items that we would want to fund in this policy because in any given year, that percentage of necessary capital projects could change. So if we have major capital projects that are ongoing and the funding is needed to continue that project, that would be certainly something that is urgent or critical that we fund that. If it's something more of like an equipment replacement, it may be something that we could defer. So that is some of the feedback we received previously, just that it could be tough to identify what percentage of CIP, because again, it will fluctuate every single year depending on the capital items included. And then finally, the natural disaster funding. We have currently $9 million in the general fund plan for natural disaster funding. That amount was included based on some numbers that Bert was able to pull from when we had, I can't recall what year it was, but when we had to replace the boardwalk. At the time, it was estimated to cost $8 million. So, today, I did pull that number for the commissioners. I'm blanking on it, but I think it was almost double that cost today to rebuild the boardwalk. So $9 million, you could make the argument that, if that's our concern with the natural disaster is the boardwalk, $9 million may be not enough to perform that replacement.
The paragraph above says 4 million for natural disaster?
Yes, and I've corrected it in the draft that's on the screen. I did catch that this morning. I apologize for that. The previous version, it was a later draft of the policy, did include $4 million for natural disaster funding. When we updated it based on that 8 million number that we pulled from years ago, we updated the figure. We just did not update the reference in the paragraph above. So thank you for making mention of that. So as the policy is currently laid out, again, we use FY25 budgeted numbers for the operating budget, the debt service costs, and the CIP. So under this policy, roughly 2.3 million in excess of the minimum fund balance. Just moving on to net position, again, for water and wastewater. Again, we've included 30% of the operating budget, 100% of debt service, 100% of CIP, and $2 million in natural disaster funding. That's sort of an arbitrary number right now. We have not, run any analysis to figure out what we would need. A lot of the infrastructure, certainly a concern would be the infrastructure that's closest to the beach as it relates to a natural disaster, but certainly there's some level of protection because that infrastructure is under the street for the most part. And as you can see there, based on the FY25 budget and the unrestricted net position, 10.9 million in excess of minimum net position. I just want to make mention, though, because we did have some comments from the public when we last presented this to the commissioners, that 10.9 million is a lot of money, and we should consider spending some of that money. I do want to make mention there is new guidelines coming out on PFAS, PFOA. This is a new requirement for water treatment, treating water to a much higher quality, much higher standard. And we're starting to look at some of the capital costs that are related to treating the water to the level that we need to treat it in a few years from now. And that will be millions of dollars. We recently toured the City of Newark's water treatment plant. I think their improvements up there were around $4 million, maybe more than that. And we believe we may have to construct the same project or the same equipment that they had done in Newark, but in 2 locations. So potentially doubling the cost of that water treatment. So just something to keep in mind. That is another comment that we received from the commissioners about this policy is, it really doesn't take into consideration 2, 3, 4, 5 years out in the capital improvement plan. It right now is just focusing on, again, the FY25 capital budget and the obligations. So something we'll continue to consider as we refine the policy. And then in wastewater, very similar to water, 30% operating, 100% debt service, 100% CIP, and again, $2 million in natural disaster. It does show currently in the policy, based on the FY25 numbers, that we are just below the minimum net position that this policy would require. And then finally, we included, this was a recommendation from the Board of Commissioners, we included just some steps to either replenish the unassigned fund balance or unrestricted net position in the event that it falls below the minimum. And then we've also identified what could be done if, or how to use the unassigned fund balance, unrestricted net position if it falls above the minimum level as specified under the policy. And then finally, this was another recommendation from the Board of Commissioners. We did include a reporting requirement on this, and this reporting requirement is an exact copy from our investment policy. And it essentially says that we will report on the fund balance and net position July, October, January, and April regular meetings, so quarterly to the Board of Commissioners to give them a clear picture on the status of the fund balance and net position. That's really all I wanted to touch on. Again, I want to thank you for your time, and certainly we can entertain any questions or comments. And again, if anything comes to mind, any comments or concerns that you have about it, ideas, don't hesitate to reach out to Bert and I.
I think it's very good, Evan. Just on the last point you made, it says that the city manager and finance director shall develop a strategy to respond on page 7. I put some sort of expected time limit in terms, have a report within 90 days or something. Sure. Just, for the reasons I think the real value of this is the reporting and the fact that it highlights for everyone that we have an issue, and then the real question is, is the issue something that the city administration is comfortable is really short-term, or is it more long-term?
Right.
The reasons we were talking about with Bert on the limitation on property taxes, certainly raises a structural issue. Let me just ask while we have you, the one thing that I've noticed in making contributions to the fire department is a concern about whether they're going to have enough volunteer firefighters and whether we're going to have to start paying for more of them. Is that something that you and Taylor and others are starting to focus on? Because that could be a quite large cost if we ended up having to start paying. As I lived in Washington area for a long time. Montgomery County went from a largely volunteer fire department, and one that was largely paid. A fire department, obviously much bigger jurisdiction, but it's a massive cost when you have to start doing that. And that's the one thing that occurred to me, other than natural disaster, that we could see start changing fairly rapidly, because it's obviously we're all extremely appreciative of the time people put in, but it is one that as the city has more and more permanent residents, big hotels we're about to build becomes a bigger issue in terms of the size and the ability of the fire department to respond promptly.
Yeah, great comment. So what I will offer is, at this time, we haven't begun analyzing really a transition from a volunteer fire company to a paid crew. I did work for a little while on the Bureau of Media in Pennsylvania. It was about 7 or 8 years ago, and they were considering that same thing at the time. Just a loss of volunteers and, consideration to continue to maintain that force. They'll have to bring them on as a paid crew. What we are looking into, though, is the development of a emergency services fee. That was something that was discussed at the commissioner level during this last draft, or this last development of the fiscal year budget. The fire company did come to the mayor and commissioners. They requested a contribution, an annual contribution. And included in that discussion was discussion about developing an emergency services fee. I know it's a hot topic. It's one that's certainly a hot topic in Sussex County, I think even the entire state. The state is actually, my understanding is that there is an ongoing study right now, and the study is analyzing every single fire company in the state of Delaware, looking at their financials, trying to better understand the needs of the fire companies. And from there, we think that study will help us better identify what an emergency services fee looks like, how it would be applied, how it would be collected. So that is sort of what we're exploring right now versus a paid crew.
Okay. And the other thing, in prior meetings, we've had discussions in terms of how much the city is covering for North Shores and Henlopen Acres in terms of expenses, things like fire department and others. Is that something, again, that we've had further review of? Because it certainly did strike me as a resident in the city that wasn't quite sure why it is the city should be covering all that. And my recollection is that the contributions from Henlopen Acres and North Shores were quite small for city services. So I'll make friends up with my friends in North Shores and Henlopen Acres by raising it.
Yeah, right. Great comment as well. We have had at least 2 meetings now with the Board of Governors in North Shores to talk about the existing agreement that we have related to wastewater services. So that's something that we're currently reviewing.
Are there other services? I don't know whether the police here, the fire company, others that are shared services, and where the question is in terms of costs being borne by either Henlopen Acres or North Shores?
Sure. So I can't speak for the fire company, but I don't believe our police respond out there.
Thank you.
Yeah, certainly. And if I could just make one comment too. You brought up the comment, your comment about the city manager and finance director making a recommendation to the Board of Commissioners on sort of a plan if the minimum level, if the amount, either fund balance or net position falls below the minimum or above the minimum. There was some comments from members of the public. I think there might have even been a letter to the editor in the Cape Gazette claiming that the city manager and the finance director are the ones who decide how to spend the money if there's an excess or what the plan is to replenish if it falls below the excess. That's not the case. We clarified that at the last meeting with the commissioners. That is the Board of Commissioners who ultimately decide that, but is the finance director and the city manager's responsibility to at least make a recommendation to the Board of Commissioners. So I just wanted to clarify that.
Okay, thank you.
Yeah.
Just one other thing on the reporting. Can you include a trend line on every quarter? Oh, can you include a trend line?
Sure. Well, thank you. Like I said, any other questions or comments or ideas, please don't hesitate to reach out to us.
Thank you for doing this.
Yeah, of course.
Thank you.
Any other business?
I guess the only thing you have to do is vote to recommend the approval of the auditor's report.
Yeah,
And,
I will move that the committee approve the, or recommend to the city commissioners they approve the audit report.
And I second it.
That passes unanimously.
It's a tough vote.
Yeah. All right, if no other business, declare the meeting adjourned. Thank you.
Okay.